I have here Louis Marcotte, the CFO of Intact Financial Corporation, Canada's largest property and casualty insurer, as well as North America's leading specialty insurance provider. Interest rates are rising across the board, and insurance companies stand to reap its rewards. But at the same time, you're dealing with a bunch of changes, whether it's climate change, political upheaval, or tech disruptions. So we're going to look at how the industry is adapting to these changes and what Louis sees moving forward. So just to start, Louis, what's your viewpoint on the state of rising rates today and how that impacts the industry as a whole?
Well, good afternoon, everyone. Thank you for listening to us. Firstly, on interest rates, well, I guess a bit of relief for the insurers in general. It's been a bit of a long drought. So rising interest rates is a favorable tailwind for insurers. P&C insurers will see some positive momentum from it. We are heavily weighted fixed income investments, of course, in the P&C sector. Probably 70 to 80% of our asset mix is in fixed income. And that's normal. We have to manage liquidity and regulatory considerations. And as such, the interest rate rise will push our returns higher. This takes time. It takes time based on the turnover of the portfolio. But in general, a tailwind, but it's not an immediate tailwind. It's a bit of a long-term tailwind. So positive tailwind, but long-term. And happy that this is finally occurring. It gives us a bit of a break. The question that comes back is whether we'll give it back in terms of underwriting pricing. Given the time it took and where the market stands, I don't think that will happen in the short term. So I think we're good to have some positive momentum from rates for some time.
And in this environment, where do you see the most value for investments?
So knowing that we are probably not big traders, whether it's equity or equity portfolio is about 15% of our total portfolio. We don't change the mix so much. What we'll try to do now is actually turn over our bonds as quickly as possible to capture the higher yields. In terms of changing where we're investing, there's not that much change. We're looking for stable, not too much volatility, dividend-paying stocks. And as such, we're not changing that much our mix or the areas of investments because of the interest rate changes.
We've seen extensive damages this past summer from Florence to wildfires in Western Canada and California and the tornado in Ottawa. How much of this has had an impact on your business and on the industry as a whole, and how are you adapting to that?
So one good reason for maintaining liquidity is catastrophes. They've come every year, so they're expected to come. That's why insurers are in business, help people get back on track. There's a sense that climate change is increasing, or there's more events linked to climate change. It's true, you had the heavy hurricanes last summer with Florence recently. In Canada, we had Fort Mac, the forest fires that were substantial as well. So generally speaking, it's a hit, but it's a temporary hit. And I think we have to see in the P&C insurance, it's also a bit of a positive tailwind because there's an opportunity for insurers to show or help communities adapt to climate change. And we try to do that ourselves, being very involved in an adaptation center at Waterloo University in Canada. But that's one way we're trying to seize the opportunity. And the other one is, when people are in trouble because they've suffered from a cat loss, we're there to get them back on track and as quickly as possible. And this is where the insurance companies really have an opportunity to do well. And that's why I think it's a bit of a positive tailwind because of the climate change. People need insurance, and we have the opportunity to do well and show what we can do when cats hit. So generally speaking, I would say, although it's a hard hit when it happens, once it's over, positive generally for the industry.
So with the opportunities you just discussed, how big of an opportunity is that? Are you able to give some sense?
Well, hard to measure the size of the opportunity. I would say it's generally it keeps the pricing in our industry hard market conditions where you're able to increase rates. So you're able to price the insurance at a better level and cover the future potential cats. So I would say it's a long-term tailwind. It's not necessarily an immediate response.
With the long-term view, I mean, climate change has been happening and there have been more and more catastrophes. Do you see that getting worse down the line, and how are you hedging for it in your business?
So will it get worse? That's hard to predict. We take long-term views on this. And when we look back, there seems to be a rise because we always tend to look at the last cat. But over time, we've seen years where there were no cats. So we do take a long-term view. Is it increasing? Perhaps. What we do on our side, there's price you can act upon, but you also can act on the product and change the coverage, put limits where limits are needed, and in the view that you can sell the product, but it's also affordable for people to get insured. So there are mechanisms for P&C insurers to both manage the pricing of the product as well as the product itself, such that if you had the same cat 2 years in a row, which is impossible, but in theory, it would cost you less to protect or to pay for the second cat because you've taken product changes and you've increased rates. So this is a bit of a way for us to do that. Then reinsurance is a third leg, where if you reinsure yourselves for heavy cats and pass the risk on to some reinsurers who will diversify that internationally. So between product pricing and reinsurance, you can manage the level of cats and hopefully get a good return year after year.
Let's talk about the tech disruptions. Last time we spoke, you talked about the risk of being Uberized to insure tech. Tell us a little bit more about that. What are your thoughts on?
So you're keeping me busy here. Climate change, interest rates rising, technology. It's actually a really exciting industry. Fortunately, InsurTech is probably a bit late to the party, I would say, or that's a bit of a perception. But technology is huge. What we're seeing in terms of big themes right now, clearly artificial intelligence and machine learning. It's live, it's working, we're using it. We see the autonomous cars. Autonomous cars, connected cars are a big issue. So it's all technology related. Sharing economy actually is enabled through technology. And then longer term is blockchain. Blockchain is not yet really, we talk about it a lot, but we didn't see the applications. But we have that on the radar in terms of potential implications. Now let me come back to artificial intelligence and machine learning here. Insurance is a business where you put a lot of data and a lot of actuaries together, and you mix the two. It's a good time for them, but the fact is there's a lot of segmentation, a lot of variables that are put together to derive some very good pricing and underwriting practices to derive profit. With the advent of more data and more tools to manage this data, it really becomes critical for insurers to stay on top of the technology, on top of the data. And so we're putting a lot of effort right now through labs to put that data together. And where it comes, the most resonating impact right now is on telematics, which is monitoring the car driving habits of drivers, of insureds. And here we're seeing some significant advances, being able to match the quantity of data we derive when everybody is driving with the claims experience, the claims or the accidents, and then get some predictive variables as to what will happen with each kind of driver. And this is really promising in terms of what we're finding. So artificial intelligence, machine learning area here is really core. Sharing economy is really interesting. We are insurers of Uber in Canada, the exclusive insurer of Uber. And this is proving to be quite an interesting development. Sharing economy is growing. What we're seeing in the US is what is called the gig economy as well. Lots of opportunities here. And we took the stance that we should be close to the sharing economy a couple of years back. It's paying off, and this keeps us close to the community of sharing economy, but as well gig economy, which seems to be growing at a decent pace.
And let's take it back a little bit. You mentioned you were looking at blockchain applications. Could you talk a little bit more about that?
I actually said it was emerging, and we're trying to see where blockchain will come into play. And there's not that many that we have seen yet in terms of the insurance space. Potentially in the commercial area, marine insurance is maybe one area we're seeing right now where it may develop. It's one where there's a lot of data to be put together between insurers around the world, so that we know something is being built on. But there's a whole notion of these parametric insurance where you could use blockchain as a structure to make enable insurance transactions more easily between parties. Which could evolve into something interesting.
Intact has invested heavily in technology over the past few years and made some acquisitions, and your peers have been doing so as well. Are you seeing that there's almost like a competitive drive to be like a first mover in this space and really delve into using that technology and applying it to maximize? Well,
clearly there's a huge investment in technology. Everybody recognizes that we need technology to perform and to stay in the business. So we're trying to mix our investments into the pillar technology, which is really making our business work. and then the customer interfaces. This is really much more about being on the web, being with applications that are quick, that provide quotes quickly, because where this is going right now, the biggest fear is actually disruption in the distribution. This is where we think if disruption will come to the insurance space, it will be in the distribution. You guys may have seen Google enter the insurance market in the US. They've left the insurance market since then. But the fear of having a player like Google, Amazon enter the market is one that we're focused on, and therefore investing a substantial amount into developing our own web presence, our own customer experiences, such that we can hold our own should such a player come to market.
Let's move on to another hot topic as well, the legalization of recreational cannabis in Canada. That's kind of one field that a lot of insurers are looking at, but given that there's a lot of regulatory uncertainty around that market, you know, no one's really come out and said they're going to be in that market yet. How do you look at that space?
So that's really interesting. Top of mind these days, this will be legal in Canada on October 17th. So I would say, generally speaking, from a personal lines insurer, this is a bit more a headwind than anything else. Past experience, and we'll refer to some of the states in the US where it is already legal, has shown that severity and frequency have risen following the implementation or the legalization of cannabis. So we expect a bit the same to happen in Canada. And this will be a headwind until we're able to get the regulators to accept that that is valid experience and therefore can price for it. And there might be a bit of a gap while that happens. It's not a huge gap, but it's a headwind for the industry. Then is it an opportunity from a commercial point of view? So we're grappling with the idea of should we insure cannabis producers? In the past, we've covered the medicinal producers, which were legal. On the recreational part, we're still looking at this as how do we deal with this? It's not seen as sort of the pot of gold that we should chase after. We're cautious. We're cautious on every front with this legalization at this point in time. It's not necessarily something we see as the pot of gold at this point.
Even that question of home insurance, you know, with people growing pot in their homes, smoking pot in their homes, like how are you guys looking at this and working around that?
Well, carefully. You get tangled up into, okay, can you ask people if they're going to grow? And in Canada, my understanding is if you grow 4 pots, it's legal. Less than 4 is legal. More than 4 is legal. And you're going to ask people, are they growing 4 or not? And will you get the right answer? It's a bit of a tricky question. You don't want to be seen also as too conservative, not wanting to insure those who are conducting an illegal activity. So I guess you go back and rely on the law and follow the rules of the law, and monitor it carefully because it's an interesting twist in the Canadian environment.
And it's happening soon.
2 weeks from now. 2 weeks from now.
Yeah. Would you guys ever consider being a first mover in that market, or is that something?
No, I think we're more cautious than wanting to be. We like the sharing economy of being a first mover, but not on the cannabis. It's a big social change, and so these are maybe issues where you want to be careful and not go too quickly.
So moving forward, what do you see are the biggest risks for the insurance industry as we move on?
So I talked about the disruption in distribution is one key areas. One other area that we're monitoring carefully is the car technology. So I talked about autonomous cars quickly earlier, but the sense is where are these cars going? And we're talking about autonomous cars. We still think they're way out in the future. They're not. I mean, they'll hit us and they'll be in place at some point in time, but it's not till tomorrow. We think there's a few years. And our view has been here that we'd start with the sharing economy. And sharing economy from a car point of view is just a notion of who owns the car. And when you look at the Uber project in Canada for us, it's not so obvious that you would have gone from insuring someone's property to suddenly you're insuring the car of someone who doesn't own a car. So we insure Uber that doesn't own the cars. Conceptually, this is not so easy. Now it seems obvious, but it wasn't at the time. And this is the whole gig economy now. You're moving into this notion of who owns the product versus who uses it. And this is where we think it's going to evolve. So you got sharing economy, then electrification of the cars, which is interesting because it will make the car cheaper to use. And if the cars are cheaper to use, then we think people are going to move more. So you got this notion of mobility where you might have less owners of cars, but people are going to move more and might have different needs to move that will need insurance. And then moving along the way, they're electrified, and then they become part of fleets, and then autonomous. So there's a few, phases of development of the cars, which we're monitoring. But this is one where eventually, I mentioned the tailwind of the climate change, which is likely to increase the risk pool, while the car pool will not disappear. I don't think anyone should be worried that the car pool risk disappears, but it might not be as big as it is today, simply because it's going to shift into some other form over time.
Perfect. Thank you so much for speaking with me today, Louis.
Thank you.
Our time
My
is
pleasure.
up.
Thank you very much.